Welcome back. Wrapping up this week's trading activity, we see quite a bit of volatility. Every yellow dot here shows us the closing price of the S&P 500. The red line shows us the weekly lows. Blue line shows us the weekly highs, and we clearly closed right on the low. Now, this is important because we can see in the past during uptrending markets, these yellow dots tend to close near the blue line, near the upper end of the range. But conversely, in downtrending markets, we tend to see the stock market close at the low of the week, which is very much the case here. The red line here represents the S&P 500. The white histogram bar shows us the Friday close as in respect to its weekly range. So when we saw uptrending markets early January of this year, we saw these histogram bars register highs, closing really close to the 100% level, meaning closing at the high of the week. But now we have no histogram bar at all. It shows us that we've closed basically on the low of the week. And it certainly is a very bearish indicator, at least for the time being. Every yellow dot here represents one stock in the S&P 500. This is in terms of their own respective RSI, relative strength readings. The dotted line in the middle is the 50% level. Then we have 30. Below 30 is considered oversold. Above 70 is considered overbought. Most of the stocks have closed between the 30 and 50 level, and quite a few actually below 30. Now, if you take a look at the video, our weekly wrap-up from last week, we saw a much different picture. It was really a lot of these, most of these dots, most of these stocks were really scattered very evenly between 30 and 70. That has changed. Now we see here, this is a count of the number of stocks in the S&P 500 at every given RSI level. 99 stocks have an RSI of 30 to 35. Another 99 have an RSI between 35 to 40. In fact, almost all the stocks in the S&P 500 have a relative strength index reading of 50% or less. Now, this is a very reactive indicator, changes very quickly. This week's trading activity sent us from a neutral to a negative trend on the stock market, on the S&P 500. Here we take a look at a little bit of a bigger picture. This is the S&P 500, every stock in respect to its own 52-week range, the yearly range. We can see a very spread out indication, no clear trend. Not like the RSI, but then we take a closer look at it, every histogram bar here shows us the count. So we have, for example, 31 stocks have an RSI reading between 45 to 50. We have 29 more with an RSI between 40 to 45. So we can see these tall histogram bars have all registered their 10 to 40 or 45% reading in terms of their own 52-week range. Imagine every stock in the S&P 500 had an annual range of $1 to $100 a share. This would show us that most of the stocks are trading 10, 15, 20, 30, maybe $40 a share. They're all relatively weak. Now, top 10 industries by RSI, by relative strength. These are the industries represented in the S&P 500. It's a very mixed bag over here. No clear trend. Recreational products, plastic products, paper, computer communication equipment, forest products. There's no clear trend. However, we take a look at the bottom 10 industries in the S&P 500. Oil refining, marketing, engineering, construction. We have real estate, hotels, precious metals, oil field services. Also, there's not a clear trend, but we do see several stocks in the oil industry, and they are heading lower. Now, this really falls in. It doesn't make sense, we should say, if we think that oil prices are going to go higher. But oil prices only go so high as the economy can support. And we've seen in the past when markets turn south, oil also turns south, because the perception is if the consumer can't afford oil, if it can't afford gasoline, then maybe we're going to see lower oil prices as well. Also, real estate, which historically has been a very strong industry, has now registered one of the weaker markets, one of the weaker industries within the S&P 500. We see here U.S. Treasuries, a 6-month bond pays a 507 yield. The 12-month bond is a 482. The 10-year bond pays a 368. It's very much an inverted yield curve still, much higher yields in the short-term maturities. Typically, we expect in normal market conditions, we expect to see higher interest rates on the longer-term maturities. It's the opposite here. Compare the 10 and 1 year treasuries. The red line are the 1 year bonds that are paying a lot more than the 10-year. The red histogram bars show us the inversion, to what extent the 1 year is above the 10-year. This is about a 127 basis point inversion at this point. Notice the past week we see a big spike down in both of those yields. 10 2-year markets, same thing. This is a 10-year bond, the black line. The red line is a 1 year. Both big spikes down, but maintaining very, very deep inversions. 107 basis point inversion was registered last week, meaning that the 2-year bond paid 107 basis points, 1.07% more than the 10-year. That is a huge inversion. This is the 1 month change in treasuries over the past month. Where has the money gone? Well, the money has gone into longer term maturities, like the 30-year. We know this because as the yields go down, it means prices go up. But conversely, they've been selling the 6-month bond and the 3 and the 4-month bond because now they're selling the bonds. The bond market is forced to offer a higher yield in order to attract investment capital. It means that traders and investors, they do not want to be stuck in those short-term maturities. Maybe they think something soon to the downside is going to happen. We see here this month in bonds, we see this as the change. The S&P 500 is shown in the blue area chart in the background. The 6-month bond is the jagged yellow line over here. We have the 2-month bond is a white jagged line here. And then, of course, at the bottom, we have the longer term maturities, like the 30-year, the 20-year, etc. So we see a very steady trend in all treasuries. Yields have really started to go down. And this is something that's happened very, very recently. You know, we saw these treasuries hit spikes earlier this week. The last couple trading days really shows us a change in the direction of these markets. So point being, you know, this is only, of course, what we see right now, and things can always change. But for the time being, we've seen that in terms of stocks, we see a lot of stocks have turned south. The RSI has definitely shown us that there's a lot more stocks with a weak trend than a strong. There's more stocks trading closer to the 52-week lows than highs. But overall, we see that while yields are also chasing this market down, there is a massive inversion. And that is, you know, not every bond yield inverted condition guarantees us a recession, but every single significant economic recession has been preceded by an inverted bond yield. And we've done actually quite a bit more in terms of studies into the inverted bond yield curve condition on our channel over here if you're curious. But we're going to continue to watch these numbers and many more very closely. We hope this has been helpful. We look forward to seeing you back soon.